All right, how we doing? This is John. I'm going to do a couple videos on option basics. This first one will be a lot of vocab, and I mean the very basics, like you've never even heard of an option before. Okay, we'll get into more complicated stuff later and trade setups and whatnot as I continue to make videos. Now, before we start with definitions, just talk about trading in general, whether you're trading, cryptos, Forex, whatever, stocks, okay? You need to find yourself a system, okay? A system that works for you, that you're comfortable with, okay? It has to be appropriate for your account size, right? It's important to watch your account size so that you can stay in the market over time. You need to be in the market over time. If you look at uh, just the stock indices, the gold chart, right? What do they do over time? They grow. And if you're in and out, bouncing in and out, buying and selling all the time, you're missing out on a lot of upside opportunity. Okay. Second, probably, bullet two and bullet three are interchangeable as far as importance. Okay. You have to watch your risk. Okay. Staying in the market over time involves watching your risk. You can't overtrade. Of course, you're going to have losers. Okay. Now, how to avoid the losers taking over is you find a system where the probabilities are in your favor and you keep hammering those probabilities, and over time, they will win out. Okay. This game takes patience and discipline. It's not a game. Okay, some of these futures platforms look like freaking video games. It's not a game. Okay, if you're patient and disciplined, that will take all the fear and panic out of your trading. Okay, in fact, a lot of the trading strategies that we teach involve taking advantage of other people's fear and panic. Okay, you're contributing to the problem if you're puking out and panicking out and over trading. Okay, to try to play catch up, regardless of your account size, right? You have to treat this like a job. Part-time, full-time, that's up to you. Okay. But you have to study. Okay. There are plenty of people around to ask and learn from. Okay. But studying is part of the job, and it's a job for real money. Now, options themselves. Okay. In order to incur a trade, right, there has to be a buyer and a seller. Okay. What happens if you're on one side here and you're buying an option? Okay. It's a contract. Now, you don't have to physically, get out a piece of paper and sign it and get it notarized. Okay. You're entering the contract when you point and click the certain buttons in your brokerage platform, okay, and put in a trade order. If someone likes the conditions of that trade order, they'll enter the other side and you have a trade. You're entered into the contract. Okay. When you're buying an option, you are buying the rights. You own the rights, you paid for them. You're buying the rights to buy or sell 100 shares of some underlying stock. Okay, it doesn't matter what it is for now. Apple, Google, etc. Okay. You're buying the rights to buy or sell that stock at some point in the future at a predetermined price. Okay, that price is set when you enter into the trade, right? So if you take a contract where you can buy 100 shares for $200, and later on the price of the stock goes up to $256, hey, you just made a profitable trade. You can go and buy it for 200 and then turn around and resell it for 256. Okay. 100 shares at a time. You have to pay for these rights. You have to pay a premium. Okay, the premium is the cost of the option. On the other hand, if you're on the other side of the trade, you're selling an option. Okay, then you're taking on an obligation. You get paid for it, you get a credit to your account, but now you're obligated to buy or sell 100 shares of whatever stock it is, the underlying, okay, at some time in the future at the predetermined price. Okay. So buying or selling, rights, obligations. That's all there is to it. Okay. You're taking on obligation by selling, or you're buying the rights. Okay. Now that's a little abstract. So let's go to the actual vocab here. The two types of options that you can enter into, buying or selling, are calls and puts. Okay. Basically, a call, if you buy a call, it gives you the right to call the stock from the other side of the trade. You get to call 100 shares from their account. So you're buying it. Okay. If you own a put, that gives you the right to put 100 shares on someone else. Okay. So you're selling it at the predetermined price. Okay. If you own a call, you're buying the right to buy 100 shares. If you own a put, you're buying the right to sell 100 shares. Okay. All options have an expiration date. You choose that when you're setting up the trade order. Could be next Friday. It could be 3 months from now. Eventually, the option will expire. Okay. Some ETFs now have daily expirations. Okay. And there are certain trade setups that take advantage of that. Most common stocks have weekly expirations every Friday. Apple, Google, like I said, any of the tech stocks, energy stocks, whatever. Okay. Back in the day, the options only expired quarterly. Right? These more frequent expirations have opened up a lot of opportunity for retail traders. The strike price, that's the predetermined price that you choose when you're setting up your trade order. Okay, it gives you the right to buy the stock at that price or sell the stock at that price, etc. Okay, the cost of the option uh, usually is called premium. Premium cost and value of the option. Okay, you can use those interchangeably. That's what you have to pay to buy an option, or that's the credit that you'll get, the premium, if you sell an option. Okay, and we're talking about both sides because most of our strategies involve buying and selling simultaneously. Okay, that's how you manage your risk. Right? You have to learn to buy and sell with the strategies that we teach. Okay, all of this information can be found in what's called the option chain. Okay, option chains are easy to find. You can just snoop around and do a Google search for Apple option chain, and there's a bunch of free ones out there. Your trading platform will have an option chain built in. The platform I use, here's a screenshot of an option chain for the SPY. Okay. And this particular grid here, all of these numbers running around here are for the expiration date of yesterday, January 26th. Okay. I took this screenshot a couple weeks ago when I first made these slides. On January 12th, the price of the SPY was currently at 695. Okay, notice in the middle of this grid here, where the blue and white separate, okay, is the 695. Okay, the yellow band down the middle are different strike prices. Okay, you get to choose among those strike prices when you're setting up a trade order. Okay, on the left, all of the left side here are the call options. Okay, on the right are all the put options. Okay, for the SPY for the expiration of January 26th. Right now, how do they work? Let's just, by pointing here, let's just think about a quick example. 670, let's take that strike price. Suppose you own the call that has a 670 strike price. Okay, that'll gives you the right to buy 100 shares of the SPY for 670 just by owning that call. Okay, which is a good deal for you because right the price is currently trading at 695. So if you were able to buy 100 shares, you'd have to have $67,000. Okay, you could buy 100 shares and then immediately make a profit of $25 a share by selling them off. Okay, now if you go over here to the left, this column called last, these were the last traded price of each of those options. And look how much that 670 call is worth. Right? It's worth more than a $25 profit by buying and selling the stock. It's almost always better to own the option and just sell it off. Usually there's extra premium above and beyond what you would get by exercising or using the option. Okay. Now the put works the opposite way. Okay. Let's say that you owned the 705 put. Okay. That would give you the right to sell 100 shares for 705. Look at that. You just made $10 a share. Okay. You could go scrounge up 100 shares for 695, and if you own this option, you could sell them off for 705 and make $10 a share. But look at the price of the 705 put. It's 1270. It's worth more than the $10 a share. So if you own this 705 call, it'd be more profitable to sell the option itself than to actually use it. Okay. This is confusing at first. It takes a while to sink in. You have to scrounge around in these option chains, look around, snoop around, and figure out what all these numbers mean. Okay. The first column here on both sides, last. Those are the last traded prices. Okay. This is a trade. There can be bids and ask prices. That's where you haggle between the bid and the ask. Okay. Those guys screaming in the pits years ago, that's what they were doing. They were bidding and asking. And if they came to an agreement on a price, they would make a trade. Okay. The delta we'll talk about in video 2, and the IV, the volatility. Okay. Volatility has a lot to do with the price. As volatility goes up, the price of the options goes up. Okay. Because it basically means traders are expecting larger and larger moves in the actual price of the stock itself. Okay. All right. We're going through it again because it takes a while for this to sink in. Even after a year of trading, you'll still have to go back and stop yourself every once in a while. What is going on here? Okay. Buying a call, upper left corner here. If you buy a call, if you're the owner of a call, it gives you the right to call out 100 shares from the other side of the contract. It gives you the right to buy 100 shares of the stock for the strike price anytime before expiration. Okay, you have the rights. But like we saw on the previous slide, sometimes it's better just to sell off the option than to use the rights. Okay, to the right, upper right, if you sell a call, now you have the obligation to sell the 100 shares. It could get called away from you by the person that owns the other side of the contract, and you're obligated to sell it for that strike price. Okay, and you have gotten paid up front for those obligations. Okay, it's a good way to take in money as you trade versus putting out money when you buy. Okay, put options. Okay, lower left. If you buy a put option, if you're the owner of a put, that gives you the right to sell 100 shares. You get to put the shares on the other person or broker, who's ever lurking on the other side of the contract. Okay. could be your neighbor. Okay? If you buy a put, it gives you the right to sell 100 shares of the underlying stock for that predetermined strike price. Okay. Calls give you a right to buy, puts give you a right to sell. Last but not least here, selling a put. If you're the seller of a put, you have an obligation. This time it's the obligation to buy 100 shares. Okay. If the person on the other side wants to use the option and exercise it on you, you're stuck. You have to buy those 100 shares. Okay. For the strike price. And I've said the words at the bottom a few times already, but now let's go through them anyway. Officially, if you use the rights, if you own a call or a put, if you're using the rights, you're exercising your rights. You're exercising your option. Okay. If you're on the other side, if you've sold one, you can get assigned, right? You're assigned 100 shares, or 100 shares is assigned away from you. Okay. I've woken up a couple times, several times, and there's 100 shares of stock sitting in my account because I had sold a put. Okay. And your broker will give you a little bit of time in the morning to clear it up. Okay. You have basically an hour to call your broker, deal with it, or learn how to get out of an assignment on your own. Okay. Just trade your way out of it. Now, what actually happens to these options? Okay. Most of them, about 60%, are closed out before they expire. So if someone has bought one, they sell it off, hopefully for a profit, not always. Okay. If you've sold one, you have to buy your way out of it and close it. Okay. You can let them expire, about 30% or so expire. Okay. Now, worthless, that's scary, right? I bought this option, it was expensive, and now it's worthless. What the heck? Well, as you get closer to the expiration date, options lose their value. There's a time decay factor. And that's important to think about before you enter into trades. That option that you paid a lot of money for could end up worthless at the end. That's why a lot of times you'll close out of them early and don't let them go all the way to zero. Okay. And then last but not least here, less than 10% of them are actually exercised. Traders aren't using options to accumulate or dump off stock. Right. And we saw it in the several slides ago. It's usually cheaper to close out the option for a profit than it is to use it to try to buy or sell the stock. Okay. Now, why is there extra value? Some more vocab here. Okay. We already talked about different names for the price, the premium of an option, what it's worth. Okay. That was in that column in the chains called last. Okay. The last traded price. Okay. That's one way to value an option. Okay. Now, how much is the option actually worth? There's a couple different ways to talk about that. If you want to use it, okay, if you want to use the option, there's an intrinsic value. That's how much you would get if you exercise the option, which we saw, with the SPY with the 656 or whatever the price was. Okay, 626, right? The price of the stock minus the strike price of this is for a call, remember? Okay. When we use the 626 and the 610 strike or whatever. Okay. If you take the price of the stock minus the strike price of the option, that's how much you would make per share if you exercised it. Okay. But we saw in the option chain that there could be extra value in that option above and beyond what you would make by exercising it. Okay. Certainly you're not going to purposely exercise an option to lose money. Right. So after you figured out how much you would make by exercising the intrinsic value, there could be extra premium in that option above and beyond that, like we saw in the option chain. Okay, that's called the extrinsic value. That's the extra value in the premium or the price that the traders are willing to pay for those rights. Okay, and that usually goes up as volatility goes up. And it's the old supply and demand story, right? Now, those definitions, they take a little work, so we'll do another example from scratch here. Here are a couple options right out of my account. Okay, I own, so I only own one of each. Okay, I own one call option that expires February 20th. Okay, on NVIDIA. I own one call with a strike price of 187.50. Okay, that gives me the rights to buy NVIDIA for 187.50 a share. Remember, it's 100 shares, so I'd have to have $18,000 to pull this off. Okay. If I actually wanted to use this option. Okay. Strike price 187. The current price of NVIDIA is 188.52. Okay. There's a lot of numbers jumping around here. It takes a while to get used to. Now, how much did that option originally cost me over here? Cost me $7.83 per share. So the entire cost was $783 to buy this option. Okay. Right now, it's worth $810. So I'm up $27 owning this option. Okay. How much would I make if I exercised it? Okay. The price is 188. I can buy it for 187.50. I'd make about $1 a share. Okay. But look at how much the option is worth. Okay. It's worth $8. I could sell it for 800. Okay. Now that will start to decrease as we get closer to February 20th. Okay. I own a put with a strike of 185. Okay. I can put 100 shares on somebody and sell it for 185 a share. Okay. Now, would that be wise? No, the price is 188 right now. Okay, why would I want to sell it for less? Okay. Now, I don't just randomly buy these options like this. I clip this out of a bigger trade setup. There's more to the picture, but I'm just going through the vocab. Okay, I own one put with a 185 strike. I own one call with a 187.50 strike price. Okay, the put cost me 633. It's now worth 553. So I'm down $80 on the put. Okay, because the price has been going up since I purchased these options. Okay, if the price goes up, your calls increase in value, your puts decrease in value, and vice versa. If the price of NVIDIA goes down, my calls will start to lose, my puts will start to profit. Okay, that's why you have one of each. Calls are a long side trade, puts are a short side trade. Okay, but usually they're in combinations. Okay, combinations more complicated than what I clipped here. These two are just conveniently side by side in my account. Now, when you're thinking about it, let's change gears a little bit because we've already covered a lot. We've covered enough of the basics that you need to go back and study and think about the vocab. Okay, take a break from that for a sec. Before we start learning about trade strategies, we need to know what's going on in the market. Okay, there are various ways to look at this, but this is the way I was trained. Right? Phases of the market. What do markets do? And notice I didn't talk about any time frame here. This could be in a 1 minute chart, could be in a weekly chart, a yearly chart, a daily chart, doesn't matter. Okay. Most of the time, 65% or so of the time, markets are in consolidation. And we'll have a graph, a picture here on the next slide. Okay. Neither side is in control, the buyers or the sellers. The market's bouncing and going sideways. It goes up a little bit, down a little bit every day, up a little bit, down a little bit. Okay. Just sloshing around, going nowhere. There are trade strategies for that phase. Okay. Eventually, one side or the other will take over, if based on news or earnings or something, and there'll be a breakout. Okay, breakouts can go up to the upside, or they could break out to the downside. Okay, if it's bad news, that could lead to a blow off. This is where the fear and the greed and the panic start to come in. Okay, blow off is a big, huge price move, a big sell off, or a huge like look at the gold price the last couple days. It's been blowing off to the upside. Okay, an awful lot of blow offs. Most of them actually end up reversing. Once the blow off is over, the buyers have run out, the sellers will take over and reverse and slam the market right back down the other way. That makes for some good opportunities for trading, blow offs and reversals. Okay. And there are option strategies for all three phases. Okay. The markets go bouncing around up and down. Right? So on this chart, right, we'll just start over here to the left. At the left here, what's it doing? Just nothing. It's bouncing around in a very small range. It's in consolidation. Okay. This is the SPY, or it's just the S&P. Okay. The father of the SPY. No, look at that. 600. This is the SPY. Okay, the Spider's S&P ETF. I'll edit that out. Any case, February, March in consolidation. Neither side was taking over. Okay. Then tariff news came. It broke out to the downside and then eventually blew off to the downside. You can see it break out here, and then eventually it blows off all the way until all the selling was done. And guess what? It snapped right back and started going up. Okay. And there are little spurts of consolidation here. Then it goes up again, consolidates up again. All the rest of the year since this was about April 1st, April 2nd, April 3rd, somewhere in there. Okay. And it's just been doing this until the end of the year. And now, since the end of the year, it's just been consolidating right up around the all-time highs. Okay. It could break out even higher, or it could pull back a little bit and break out to the downside. Predicting what it's going to do is very, very difficult. Okay. No matter what you think you know or what gimmicks you can try, right? You can interview every trader in the world. You still wouldn't be able to guess what the markets are going to do next. That's not a good way to trade. It's better to react, wait for something to happen, like wait for this blowout, and then catch your trade on the reversal. Okay. Or make a trade that's profitable in consolidation. Okay. And then once it breaks out, there are a lot of traders that wait for a breakout to happen, wait for it to confirm, and then they'll trade the breakouts. Okay. And follow the trend. There are traders that follow trends. There are traders that go against the trend and use reversals. A lot of traders do both. Okay. Because they know how to read the footprint of the chart. They don't try to guess what's going to happen over here. They can already see what's happened here, and then that tells them what to try next. Okay. All right. Now, options themselves, they're very useful for lots of different things, depending on who you are and what you're doing. The cattle people use options. Okay, whether they're the producers or the processors, the packing plants, they're using options to protect their prices, or they're using futures contracts. Same thing, right? Okay. As far as us, retail traders, looking to grow our portfolios and make profits. Okay. Options can be used to leverage blocks of stock. Okay. You can use options to represent 100 shares and pay $800 for the option. It only represents it for a short time, but it's a lot cheaper than buying the 100 shares. Okay. You can use options to hedge a portfolio that you own. You worked your butt off, you built a big nest egg, you have a nice stack, you want to protect it. You can use options to do that. In fact, that's this set of slides is from class number 1 of a hedging class. Okay. You can use options to grow a portfolio. There are trade setups where if you don't own a stack already, you can play IRA catch up. Okay. If you eventually learn and know how to combine options, it makes it very easy to manage your risk. Okay. When you're entering into a trade. In fact, when you enter a trade, you should know your risk when you enter the trade. Okay. Some trades you can actually predict the reward from the trade if it's a max winner. Some of them have unlimited upside. It depends what kind of strategy you're playing. But in any case, you should know your risk up front. Okay, you shouldn't be making a trade that's risking 50% of your account. In fact, a lot of traders have rules about that. They'll only risk 5% of their account per one trade or something like that. Okay. A lot of option setups can be automated. Okay. There are software packages available already if you don't know how to code. Okay. You can automate. If you don't have time to sit and watch your account all day, you can have software making trades for you. Okay. You can trade directionally. You can trade to the long side, you can trade to the short side, or there are trade setups where you don't have to choose sides. You can trade both sides at the same time. Okay. Another nice thing about options, you get to choose the time frame. You can take options that expire next week. You can find options that expire next year. Okay. You have to keep in mind that the closer they get to expiration, they will start to lose value. You have to take that into account. Okay. Which is what makes selling options very profitable, because if you sell an option, you get the credit up front. If that option loses value, you don't have to pay very much to close it out, to get out of it. Okay. There are combinations of options for all phases of the market. Okay. There are combinations of options that allow you to hedge a portfolio. Okay. No matter what your combination that you're making or learning, you should be able to define your risk up front. And sometimes you can define your reward up front as well. Okay. Quick recap of the vocab. I'm 4 minutes over. I might go back and edit this and re-release it, but whatever. Okay. Recap of the vocab. Call options, put options. It's confusing at first. You got to study and look around. Look at option chains. Okay. Try to listen to other traders. Right. Just remember that these option contracts are giving you rights or you're taking on obligations. That's the whole game. Okay. Usually they're not exercised, but they can be. And eventually we'll have a video on how to deal with an assignment. Okay. The strike price, that's the agreed on price when you enter it in a trade that you have the right to buy or sell or the obligation to buy or sell. Okay. Options have an expiration date. You get to choose that yourself when you're setting up your trade. Okay, in the next video, I'll actually have my account open and I'll show you some orders. Options cost money if you want to buy them. You get a credit if you want to sell them, the premium. Okay. We did a couple of calculations of intrinsic and extrinsic value. Okay. There'll be some homework on the next slide, just calculating those. Okay. Just remember that there is usually early on in the phase of the option itself, there's extra value in the option above what you get if you exercise it. Okay. It could be a lot. It could be 2 cents, depending on how volatile the stock is, the underlying stock. Okay. We'll have a video on exercise and assignment, like I said, and then you need to start to look at charts and study charts. Study the wheat chart. Study the yearly wheat chart, the weekly wheat chart, the daily wheat futures. Study the SPY. Study gold. Okay, whatever markets you're interested in, Apple stock, Nvidia, whatever. Okay, you can find all these charts for free on Yahoo Finance. Okay, they're 15 minutes delayed, but oh well. If you're not trading yet, you don't care. This is for study right now. Next week the next video. This is a weekly class, but I'm making practice videos to release on YouTube. We'll look at the volatility, what that means, assignment and exercise. Okay, we'll briefly go through it, but I'll make a whole entire video on how to actually deal with it later. We'll talk about delta, maybe some of the other option Greeks. Okay. The way I learned option trading, the Greeks aren't that big of a deal. And if you go on like Reddit groups or whatever and listen to them, the Greeks, they throw the Greeks around a lot. Okay. Beta, theta, whatever. Buying and selling, we'll practice, we'll look at some orders. Okay. Trading out the money. The strategies I learned are traded at the money, as close or as near to the actual price of the underlying stock as you can get. That's where all the tension is. That's where all the potential is. That's where all the volume is. Okay. There are people that trade away from the money. That's fine. That's what makes a market. Okay. We'll talk about how to calculate the expected move. Okay. What's the stock expected to do? You can calculate that using options. Okay. Now, is it always accurate? No. Who expected gold to do what it's doing the last? Well, I don't know. It depends how you look at it. The last 6 months. Since April, gold has went up from 3,000 to over 5,000. It took forever to get to 3,000. Now it's up to 5,000 in 6 months. And the last couple days, it just keeps going up and up and up. 500, $800 a day. Okay. Can you anticipate that? Well, you can get at least a rough estimate of it. Liquidity. Liquidity is important for it's just how much that particular stock or option is being traded. Okay. It's important because once you're in a trade, you have to get out of it at some point. And if there's no other traders in that market, that's not a very good stock to dabble with. Okay. So the way I learned, we only deal with liquid stocks. Okay. And I'll show you my watch list right out of my account so you can see what I look at every day. And now just stuff to think about. It's up to you how seriously you want to take this. Again, this is for brand new people that have never really watched this stuff at all. Check out the S&P chart, okay? And compare it to the SPY chart. Use the same time frame. Look at the daily. Start with the daily, okay? Watch what happens to the S&P on a daily chart. That's the one I showed you earlier was the daily chart for the SPY. Okay, and compare those two. You should see a pattern. Okay, just watch how they behave. See if you can identify the phases of the market. What were they in last month? What are they in now? Okay. It's important to eventually, not at first, you got a lot of help at first. It's important later to be able to identify what the markets are doing. You won't always have someone there holding your hand when you're trading. Okay. Go or snoop around the option chains. Okay, but I mean, I put a specific example, but you don't have to use Amazon. Okay, I just randomly picked it. Okay, go in the option chain for Amazon to the February 20th expiration and see how much the 250 call is worth and the 260 put. Okay, I don't even know what Amazon's trading at right now. I can look, but we're up to 40 minutes already. Okay. Then take that 250 call and the price the day you're actually, if you're doing this little exercise here, calculate the intrinsic and extrinsic value of the 250 call and the 260 put. Okay. One or other could be zero because the price could be up to 280 or down to 230 by then. Okay. But try it, mess around. You're not going to learn anything if you don't get in there and dig around and look at stuff and know what you're looking at. And like I said, next week we'll analyze a couple other columns out of those option chains. And then you'll start to notice that they look different. Okay, the option chain that I showed you was from my account. They look different on certain websites because they only have the calls on the screen at once or only the puts. Okay, I kind of like the one I have because you can see both sides. All right. I will see you next for part 2 of option basics.